How to make money off dividends. Stock dividends are distributions of additional shares of stock to existing shareholders of a company. When a company declares a stock dividend, it issues new shares of its stock to its shareholders on a pro rata basis, meaning that each shareholder will receive a certain number of new shares for every share they already own. For example, if a company declares a 10% stock dividend and a shareholder owns 100 shares of the company's stock, they would receive an additional 10 shares as a dividend. Stock dividends are different from cash dividends, which are payments made by a company to its shareholders in the form of cash. Stock dividends, on the other hand, increase the number of shares outstanding, but do not affect the value of each individual share. However, stock dividends may be seen as a positive sign by investors, as they can indicate that the company is doing well and has enough cash on hand to reward shareholders with additional shares. There are a few ways to make money with dividends. Receiving regular dividend payments. If you own shares of a company that pays dividends, you will receive regular dividend payments. These payments can provide a steady source of income, especially for retirees or investors looking for passive income. Dividend growth. Many companies increase their dividend payments over time, which can provide an increasing source of income for investors. This can be a particularly attractive option for investors who are looking for long-term growth and income. Dividend reinvestment. Some investors choose to reinvest their dividend payments by using them to purchase additional shares of the same company. This can help to compound your returns over time and can potentially lead to greater long-term gains. It's important to note that not all companies pay dividends, and even those that do may not offer significant or consistent returns. As with any investment, it's important to do your research and consider a range of factors, including a company's financial health, growth potential, and dividend history, before making any investment decisions. The best time to buy dividend stocks is when they are undervalued or when the market is down. This is because when a stock's price is lower than its intrinsic value, it may offer a higher yield, which means you could potentially earn a higher dividend income. Additionally, buying dividend stocks during a market downturn can be a good long-term investment strategy, as the market tends to recover over time and dividend-paying stocks can provide a steady source of income during market fluctuations. However, it's important to note that investing in stocks always carries risk, and there is no guarantee that the stock price will rise or that dividends will continue to be paid at the same level or at all. It's important to do your research and consider a range of factors, including the financial health of the company, its dividend history, and the overall market conditions, before making any investment decisions. It's also important to have a long-term investment strategy and to be patient with your investments, as dividend stocks are often best suited for a long-term buy and hold strategy. You can use dividend payments to buy more shares of the same company or other investments. This is known as dividend reinvestment, and it allows you to compound your returns over time. Dividend reinvestment plans, DRIPs, are offered by many companies and investment firms. With a DRIP, your dividend payments are automatically reinvested in additional shares of the same company, typically at no cost to you. This can help to increase the number of shares you own, and can potentially lead to greater long-term gains. Alternatively, you can use your dividend payments to purchase shares of other companies or investment products, such as exchange-traded funds, ETFs, or mutual funds, which can provide diversification and potentially higher returns. Dividend reinvestment can be a good long-term investment strategy, as it can help to maximize your returns over time. However, it's important to consider the tax implications of reinvesting dividends, as you may owe taxes on any dividends that are reinvested. It's also important to keep in mind that dividend reinvestment is not a guaranteed way to make money, and it's important to do your research and consider a range of factors before making any investment decisions.